Hey everybody, the housing market made the news this weekend that home prices cooled at a record pace in June. The company Black Knight, who's been actually reporting and actually reviewing this statistic alone, has been watching it since the 1970s, reports that this is the slowest cooling of the housing market on record, okay? Yet again, causing concern for folks that believe that this probably is not going to be as bad as 2008, 2009. Black Knight notes that this last month in June, month over month home appreciation nationally dropped by 2 percentage points over prior month, okay? To give you an idea of how this looks against the last time that we had a housing market slowdown, home prices only changed in 2007 to 2009. The strongest single month change during that last slowdown was 1.19 percentage points. You got that, 1.19. And the changes of 2007, 2009, whenever the market started to drop off, was not as significant as what we saw last month. The average rate on a 30-year mortgage crossed over the 6% mark in June, and then obviously they're back down to 5%, even as the Feds changed rates last week. And here's an important thing to note. 2% is across the board average for the nation. 25% of major US markets saw their growth slow by more than 2%, in some cases 3%. And there were multiple markets that actually decelerated by 4 percentage points or more. So obviously topping the charts is Denver. You have Boise still in rough shape. You have San Jose, California, Bay Area real estate not doing well. And you know, a lot of this is built on the back of national activity and amount of homes that are actively for sale spiking on the back of the interest rates changing. Buyers just pulling way back off the marketplace. Inventory across the average of the US changing 22% in just a couple of months' time. I remember I reported recently in Florida, housing inventory changed 50% from March to June, 50% increase in available homes for supply. Builders had been ramping up for months to find that their homes are not selling and now canceling in record numbers. And all of this on the backdrop of people really scratching their heads to see how bad will this market be, okay? How bad will the market get with so much deceleration? Will the buyers pick back up? And as a result, you know, recent data shows that this could actually get a lot worse. You know, when you have so many buyers backing out of the market, marked by 2 weeks ago, having us see a 22-year low in the amount of new buyers entering the path to apply for home mortgages, you're really left with cash buyers in the marketplace. And a lot of the institutional cash money that people were expecting to keep the market propped up just isn't there anymore. So you have all that to say that there's going to be some interesting times ahead. What I think has really created a lot of chaos in the market is a lot of the high demand marketplaces that really blew up. You know, we had a 44% home price appreciation growth since the pandemic on a national level. You had many markets where I'm at that grew 80% in that amount of time. Some of them, you know, certain categories, 80 to 90%. Kissimmee, Davenport, some of these areas that are pockets around Disney where we have high Airbnb properties being sold. There are a lot of those that just really went up in price really, really fast. You know, with all that being said, we've got these same popular markets, Phoenix, Las Vegas, LA, I reported last week, all of them have crossed over the border recently between how much it takes to rent a house, how much it takes to mortgage a house. It's now becoming cheaper, in some cases like Las Vegas, significantly cheaper to rent a home. You know, you pin all that on the back of GDP changing. You've got, you know, now 2 quarters back to back, everyone tangling over if they're in fact in a recession because you have 2 low quarters of GDP. And I'm telling you, the largest companies are slowing their hiring and even laying people off. Amazon over the weekend reported they're hiring at the slowest pace since 2019. They've laid off 100,000 workers in the last quarter, okay? Now, is that a sign that things are going in the right direction? Are we in a position where people can pay back their mortgages, or are we in a worse spot? And I gotta tell you, this isn't something I'm gonna cover today, but delinquencies are rising, okay? The percentage of delinquencies as a percentage of how many there are is rising dramatically. Again, it's not an alarming pace. But what happens when the economy starts to hit people to the place where they can't pay their mortgage? Okay? And I realize everybody's saying, what are they going to do? Are they going to rent? Why would you rent if you own a house and your mortgage payment is factored at 2.5% 15-year fixed mortgage, or such a low interest rate of 3.25%? Why would you get rid of that to rent? Because all of your wealth is tied up in your house. And if you're worried about feeding your family, you're going to sell your house. And if delinquencies keep creeping up, if people start, you have this issue where people are going to be in a position where they have to sell. You have some hedge funds dumping properties already. I'm seeing Open Door taking crazy low offers. So, negotiating off of their numbers like they weren't before. Like 5 months ago, they weren't taking $30,000, $40,000, $50,000 offers that were off their asking price. And they're doing that now. In some of these highline markets, man, you're seeing dramatic price reductions to see these homes sell. And in real estate, the value of your home, the value of an asset, the asset value itself is based on what the last guy sells for. So as you start to see these price reductions set in, a lot of people are really dismissing that as not a big deal, as that's not an indication of a downturn in the housing market. And, when you start setting new trends, you start adding to the fact that we're going to have an economic piece where people are going to be selling in duress situations. They're not going to be messing around and trying to quibble over the highest price. They're going to try and get out. And whenever you start to see those new prices set in specific areas, you're going to see them, I think, falling dramatically. I think in the next 2 years, we're going to see a significant change in price, which again is welcome. A lot of people are welcoming that because there's a lot of people locked out. When you have renting costs less than it does to buy a house, you got a problem, and it can't stay that way. So all that, again, I think translates to a cold winter ahead, and we'll have to see what happens. One of the things that I find very, very interesting is while we're seeing such negative reports in housing, you've got to understand there's a lot of buyers that are still in the market that when the interest rates spiked, they had been trying to buy a house for a year. They're still trying. Okay, those people are still in the market getting houses now and getting out of the way, yet we're still seeing massive negative trends. So buyers that are in the system aren't enough to keep the market up. What's there is actually already seeing dramatically negative reports, which is very interesting when you see reports saying that the level of buyer activity is very low behind the current trend. Okay, and all that means is, it's like you're worried about a house. Like, you think about a house and its resilience to a storm. It's like the equivalence of this is you've got a level 2 storm hitting the house right now, and the house is starting to buckle and it's not looking good and it's starting to get to weak. It's weakening, right? And then you hear a forecast that there's a level 4 storm behind it, and you're going, this doesn't look good. Okay, if the house is having a hard time withstanding the buyers that are in the system now and they are not able to handle that load, what's going to happen after that? Okay, and that's why I think the current amount of buyer demand is going to be through the system by around Christmas, and it'll be very interesting to see what the reports look like coming into next year. I'm still exposed to the market, y'all. As far as personal investing is concerned, I do not. If you got a property that you live in and it's got a lot of your personal wealth in it, and it's done crazy well in the last couple of years, I'm the type to sell those kinds of things and rent and sit on the sidelines and watch the market shift and invest my money in the meantime. So my personal exposure to real estate in a time like this, people ask a lot, what do you do with it? I sell my primary res and then I invest in buy and hold and flips even now. So we actually have a company called NestShare. If you're not familiar with it, check it out, nestshare.com. We do some very cool high return buy and hold properties in the Orlando area. Very high demand for those properties. They make great money, and their investments, as far as the properties are concerned, they're very, I think, resilient to recession. And if you look at them, I think you'll agree. And they make great money for investors. If you're looking to flip, I'm always raising capital for flips that I'm doing personally. Check us out, the description below. You can jump in on some of these properties that we're doing. I'm going to feature some of those in the future as well. But thanks for watching. Leave some comments below. Am I wrong? Do you think the market is going to be fine? Is it just going to flatline? What is your perception? How is your current market doing right now? Continue the conversation below. Thanks for watching. Subscribe to the channel if you're not already following us for updates on nearly a daily basis of what's going on in real estate. And as always, give the video a thumbs up if you appreciate the content. We'll talk to you real soon.